Hey everybody, Patrick Jackson with Mann Mortgage with another market update. Today's May 12th, and believe it or not, since our last update, the markets that directly affect mortgage rates have actually done well. Stock market hasn't done well. Bitcoin and things like that have not done well. But the things that directly affect mortgage rates have actually done well, and mortgage rates on the 30-year conventional are actually, as of this morning, at about a 2-week low. So not a 2-month low or a 2-year low, but a 2-week low. But we'll take what we can get. That being said, there's a survey that goes out to all the lenders, industry wide, and they turn in what their current rates are for certain types of borrowers. And the average right now for a highly qualified borrower across the country is about a 5.35. So highly qualified borrower means, great credits, at least 20% down, things like that. So not someone barely qualifying, but, really high qualified borrowers, we're at about a 5.35. And it actually might have dropped down a little bit more as the days gone by, but right about there. And obviously that's not where we were last year, but it's better than we were, as of the last couple of weeks. So the best way to kind of track the 30-year rate and where things are going is to kind of pay attention to the 10-year U.S. Treasury. So real quick, I want to share my screen and show you guys this chart. So this blue spot is the U.S. Treasury, and the orange is mortgage rates for a 30-year fixed conventional rate. And as you can see, they kind of stay lock and step. So even back when things were good and rates were a lot lower, Treasury's up here, but the things kind of stay as things go, that goes up. And really the last couple months, you can kind of see they're basically lock and step. And as we can see, they've kind of dropped down over the last month or last couple days or so. But still, as you can see, this is a very good tool if you're a novice and you just kind of want to pay attention. Hey, I wonder how rates have been doing. You can kind of look at the 10-year U.S. Treasury and get a pretty good idea of what you're looking at. Besides that, on the subject of housing inventory, the mainstream media this week has been pushing a narrative that housing inventory is increasing. The numbers really don't back that up. If you look at the numbers currently from going back to this time last year, inventory is down about 12%, so hasn't gone up compared to last year. And listings compared to this time last year are down 67%. So maybe inventories increase from its lows over the winter, but compared to the same time last year, both listings or new listings and just general housing markets have both decreased quite a bit. And on the mortgage side of things, just for people that think maybe people start defaulting and houses will become available that way. On the mortgage side of things, delinquencies on loans right now are really low, and foreclosures are at a multi-decade low. So there's no help on the horizon on that thing. People have a lot of equity. People are in good shape in their homes. So it's not like all of a sudden all these houses are going to become available through foreclosure. On another topic this week, inflation numbers came out on Wednesday. We got the CPI, the Consumer Price Index, which came in lower. It came in lower compared to last month, but higher than it was expected. And then today, the PPI came out, which is the Producer Price Index, and that came in. It was up. So the problem with that is that could lead to further pressure on the consumer side of things. So if companies start if it starts costing them more money, if their costs inflate to produce items and goods, then they're going to definitely going to pass that cost along to the consumer. And so that could continue to put pressure on that CPI, the consumer price inflation. So inflation, hasn't gone away. It's not going to go away anytime soon. We're trying to get it under control. And that being said, I want to share my another real quick graph here with you guys. So this one right here, let me get myself out of the way a little bit. So that's the Fed funds rate. So the Fed rate basically is the blue, and red is the CPI, the Consumer Price Index, with the food and energy taken out. So just core costs. And as you can see, the Fed rate was really, really low, started to climb kind of here, but you can really see in 2020 where they diverge and where our current inflation issue happens. So the Fed raised their rate or lowered their rate down to 0 in 2020. And then in about 2021, you can really see where the inflation kicked in and started going where we're going now. And then you can see here at the end of the chart, you can see in 2022 where now the Fed has raised their rate again. And here at the very top, we can see that inflation number is coming down. So obviously the Fed raising their rate did what it's supposed to do. It's starting to curb that inflation. It hasn't happened very quickly. And really, it makes you think, why did they wait this long? Why couldn't they have done this, here, maybe here, and started raising their rates, and then maybe we'd be a lot further along the recovery line. So, given everything that's going on in the market, let me get out of here. So given everything that's going on in the markets, it's still a great time to buy. We're in a little bit of an upswing right now. So if you were in the market looking for a loan, you're a realtor, you have clients that are looking to lock, now would be a pretty safe time to lock since we're at a 2-week low. There's no guarantee things are going to continue to go like this. There's technical things we could talk about, but I won't bore you guys. But there's a good chance that maybe right now is the lowest we're going to see for a while. So if you're in the market to buy, locking your rate right now wouldn't be a bad idea. And then, the next thing we're going to probably start seeing a lot of, especially if things get tighter, is cash out refis. And, really, there's a lot of situations where it makes a ton of sense, even with rates higher than what the person currently has. So if a borrower has, a bunch of car payments and credit card payments and their current mortgage, and, maybe their rates in the 4s or 3s, or maybe even lower than that, depending on when they refied, refining out of that rate doesn't make a lot of sense. But if you could take all that equity they have, after the last couple of years and go and pay off a bunch of these debts they have with that cash out refi, and then at the end of the day, their monthly debts end up being lower than it was even with a higher mortgage payment. So in that situation, to me, that makes a lot of sense. And that's probably what we're going to see a lot of going forward. And we already are starting to see that. So if anybody has any questions, I'd be more than happy to answer. If you guys need anything, please reach out. Hope you have a great day and see you next week.